All right, traders, thank you very much for making this webinar on news trading. I do appreciate you taking the time during a very busy news trading day. Later today, by the way, we have got FOMC data coming out of the US. A potential interest rate move may happen. Nothing is certain, of course, but we would, of course, advise for you to take some serious caution when trading FX today. Today is expected some pretty heavy volatility. For those of you that actively trade the news, this is a especially topical webinar that we will be presenting to you today. As you know, news trading is very profitable if done correctly in FX. It's a price action strategy. And generally speaking, it's not necessarily for scalpers, but mainly for those who are trading the fundamentals. Okay, so we're going to discuss today the entire gamut of variables that are associated with trading the news. And at the very end, I will take, of course, a questions and answers session. If I've missed anything, please go ahead and email Tickmill or your account manager at Tickmill, and they'll be very happy to help you out. Now, if you can't see or you can't hear me right now, please let me know, and we will try and sort out any technical difficulties. The agenda is to give you a quick intro on who we are. Then I'll discuss price action versus mean reversion. And also we will then get straight into how to trade the news effectively in currencies. And then I also want to discuss briefly the dangers that are specific to trading currency news in currency trading. And then, of course, a quick Q&A at the end. So with respect to your news trading, it's obviously important to have low spreads. This is something Tickmill offers, no requotes. And the trading style, the trading platform accommodates all types of strategies, short and longer term. And of course, for scalpers and arbitrage is accommodated as well. Please note there is also no negative slippage effects. Funds are of course segregated when you do deposit, and there's full transparency in the platform. I am required by the law to read you this disclaimer, so please bear with me. The contents of this material are provided by a third party, not Tickmill, and are for informational purposes only, and do not constitute investment advice. Tickmill and the speaker assume no responsibility for any potential errors, inaccuracies, or omission in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Tickmill unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a very high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. All right, let's get into it with that out of the way. So for those of you that are new to FX, you will typically find that when you do start trading more prolifically, more frequently, you will normally be greeted by two types of markets. The first type of market is less common, but it can be very forceful. It's effectively a liquidity-driven trending market. You normally get a news event or an event in the market that could be technical in nature that results in a breakout where the price shoots up or it shoots down. And then it forms a waterfall type of trend, which can last as little as 10-20 minutes all the way up to a few days, depending on the potency of the event. Trading price action is more profitable if you are successful at identifying it. Mean reversion is what the market does when there is no new information that needs to be priced into the asset class. In this case, let's say we're discussing Euro-US dollar. The Euro-US dollar will stop going up or down in a trend. It will actually range between support and resistance levels when there is no meaningful news flow in the market. When news enters the market, a repricing process happens, and this is what causes the price to shoot up or down. And effectively, when you're trading news, requires you to identify price action quickly, right? You can't wait one day, you can't wait a few hours before the price has already moved. And we saw this with the GDP data today, the Monetary Policy Committee information where all members of the MPC voted 9-0 in favor of a rate move next time round. And that was in line with expectations, but it still shot the pound up. And you need to capitalize on those moves relatively quickly. And that doesn't mean taking a position before the news is out. That's not a smart way to trade the news. But the key thing to note is you have to be able to differentiate between a ranging market and a trending market. And generally speaking, news is traded or lends itself to the price action trending type of markets. All right. A few known unknowns that I think it's important that we address. Today, the U.S. Releasing its interest rate decision is, of course, very topical and will give more clarity on these known unknowns. But what is very important for you to note is that right now, specifically in Q1 or Q2 of this year, there are a lot of eventualities that will kind of play out and that will impact your trading and impact the volatility nature in the markets, in the FX markets. Let's go over some of these. So as you know, a few months ago, the ECB started a $60 to $70 billion a month asset purchase program, which was to aimed at basically to shore up the EU economy with cash and to allow it to recover quicker. The question, of course, is that amount enough? Are we seeing enough data points out of the Eurozone across the fringe, the periphery, but also in the core economies like Germany, France, and Italy to actually allow the ECB to possibly reduce this amount of purchases, or do they need to increase it? And of course, over the next few months, it'll become very clear how much of this is important, and that will impact the euro up or down. But more important than that, of course, is, and this information we should be receiving in the next few weeks, which makes it that much more important that you realize when you're trading the euro, what seems like a trend could reverse very quickly. And this is headline-driven trading effectively. What's happening in the next few weeks is probably going to be headlines. You're going to get surprise breakouts, which were not in your economic calendars, and this could be driven by news coming out of Greece, whether they are going to meet their coming payments, whether the IMF is finally going to actually, the IMF and the Troika are finally actually going to be meeting some sort of accord with Greece. This remains a key known unknown. And however this plays out, it will cause heavy volatility and create trends in the euro. And then if you look at oil and all the commodity-related currencies like the CAD or the AUD, oil has suffered a systemic shock. It's actually come back down from 100 in its, its levels, high levels a few years ago, all the way to 50 to 60. And the question is, will the OPEC and other nations eventually either talk up or engage in a supply side response that would result in oil prices going up, and with it that impacts, of course, the commodity driven currencies. And then last but not least, please observe that the entire talk of the dollar and the dollar being talked up in the last year by the Federal Reserve and also by news agencies across the world has resulted in a lot of dollar strength. And the question is, are the data points out of the US this year actually allowing or supporting a proper rate rise or the normalization of US interest rates, which some would argue is long overdue, some would argue it's too premature to raise rates in the US. Today we'll give you a lot of color on this in about 6 hours time, 5 to 6 hours. So there's a lot of known unknowns in the market. You're going to have a very volatile trading ahead, but this still will give you enough opportunities, either headline driven or event driven, where you're waiting for the news to be released so that you can trade them. All right. Trading the news requires a bit of planning. Firstly, we would suggest that you pre-plan what news events you're going to trade on any given day. For example, today, after this webinar, if this information that we impart to you is of use, you can possibly go away and actually try it out. First, do it with demo money on the FOMC and the interest rate announcement later today. It couldn't be more topical than it is today that we're giving this webinar. So you need to pre-plan this, and it will take you a few hours to do a bit of research to understand the mode or the mood the market is in going into this interest rate decision today. All right. So it's important to pre-plan. You can't just wake up, put your MT4 terminal on, log into Tickmill, and then start trading, and then give yourself 20 minutes to prepare for a major news event. That normally is rushed. So please pre-plan. The second thing is, what major news events should one trade in general? We're going to go over these. There are 6 major events that we have handpicked out that will give you the largest bang in price in terms of the breakout and the eventual trend. Hypothetically, there are over 100 news events you could be trading, but a lot of them are noise and they're just absorbed by volume. So you want to trade the events where there's a significant price action opportunity, right? And then we'll discuss calibrating. The calibration of your charts, how to trade news, and what kind of charts you want to set up, what time frames you want to be looking at, and we'll discuss, of course, take profit and stop loss levels. So for those of you that are very new, I mean, this may not apply to the majority of you, but for those of you that are new, when you're pre-planning your news day, do not trade the news on the fly. You lose money, right? You need to take this seriously. So firstly, please get access to an economic calendar. This link here, as you can see, gives you access to a real-time economic calendar, which shows all the major country-specific economic and political news events, and also generally will show you the impact on which relevant currency pair will be affected by those events. All right? We would ask you to please focus on major events, which is normally 4 out of 5 stars, or those that are indicated in red, right? Not orange or yellow. Yes, orange events or medium impact news events can be traded, but a higher return and lower risk strategy from a risk reward standpoint is to trade the red events or the 4 or 5 out of 5 star events. Now, so you've pre-planned your news day. Now let's discuss some theory, some fundamental theory, and it's very important that you get your head around these key 6 or 7 tradable news events that happen almost every month, if not every month, that can perpetuate these trends, which you want to trade in the direction of, right? When you're trading news, you're trading in the direction of the trend. It's very risky to trade against the trend, betting on mean reversion. Timing that takes excessive or great amounts of skill, and it's just not worth the risk or the reward. So it's important that we spend a little bit of time in explaining how these 6 or 7 key news events can drive markets and the underlying currencies. All right. The first and foremost and the most important news event that you should actively look to trade if you are looking to become a news trader or if you are looking to dabble in news trading is interest rate decisions. Interest rate decisions effectively are a tool, a monetary tool, not a fiscal tool. So it's not one that the government will do to move or tamper with aggregate demand in the economy, consumer demand, but mainly with the view to control the supply of money in the economy, right? So it's a monetary policy tool. The ability to vary interest rates effectively is a monetary policy tool. And it indirectly or directly increases or reduces the supply of money in the economy, right? And the way this works, simply put, and let's take the Federal Reserve in the USA. Their interest rate decisions are the most watched by the markets, followed by those in the Eurozone, and then, of course, in the UK and elsewhere in major Chinese and Asian economies, and then, of course, the Japanese economy. But let's focus on the news events that are the most market moving and the ones most focused on. So in the US, the Federal Reserve, as you know, has followed since the last 8 years, since we had the financial crisis after the Lehman Brothers insolvency, has followed a ZIRP policy, which is effectively zero interest rates policy. And that's been necessary in order to ensure businesses in the US continue capex spending. They continue spending on the economy. And that, of course, results in more hiring, which in turn results in more consumer expenditure, which in turn drives up GDP, right? So you need to have a low interest rate environment when the economy is suffering. It's been, however, close to 7-8 years since we've had a very weak US economy. And now in the last 1 or 2 years, we've started to see good signs of improvement, both on the job front, on the hiring front, on the consumer confidence front. And so a lot of talk has come about in the USA with regards to potentially raising rates again. Now, the rates, if they go up, so they're currently at 0 or 0.25, and if they go up to 0.5 or 1%, they used to be at 3.5%, 4%, which is a normal rate level. This process of rate normalization, what this basically does is it increases the percentage return that I, as an investor in US dollars, get. When I buy the US dollar, and by doing so, what I'm effectively doing is I'm putting dollars in a bank, for example, instead of earning 0% on my cash, I'll be earning 1% or 1.5% or whatever the interest rate is, minus banking fees, what have you. So that's the first effect it has. And I am just, of course, one retail trader, but imagine if if in a hypothetical scenario, the US raised interest rates from 0 to 2% or 4% over a period of 1 year. Imagine the flow of funds that will come from abroad, from euros. Euros will be sold and the money will go into the US and the demand for dollar will go up. And that's what makes the dollar shoot up so strongly on the days when interest rates go up. And the reverse holds true for when interest rates drop. The demand for dollar will eventually drop, and investors already sell ahead in anticipation of that. That's the key thing to note about news. News moves the markets much quicker than the actual economic impact of interest rate decisions, right? So if the US raised interest rates today by 1/4 percentage point, the dollar would probably rise 100 to 200 basis points against the euro. Sharp move up, but the actual economic impact of that may take months to play out in the US economy. But the markets price this information very quickly. Okay? And there are two things going on here. So I'm going to explain this now. There's a bit of macroeconomic jargon here, but it's important that I explain this. The first key thing is that, okay, as I mentioned, the yield goes up. The interest that the bank pays me on my US cash deposits goes up. So the demand for dollar as an investment goes up, both domestically in the US, but also foreign direct investment into dollars goes up. That's what makes the dollar move up. The second impact is also that the amount of money supply, money being lent, also reduces, right? Because it's more expensive for businesses in the US, local business, small, medium, even large corporations, to lend money. It's just become that much more, the interest rate on loans has gone up, right? And that feeds through to mortgages as well. So generally speaking, raising interest rates in a weak economic environment can crush or throttle the economy, which can be very bad for the dollar in return. But if the economy is doing very well, it's dangerous to have very low interest rates. Why is that? Because inflation sets in. You have too much money supply chasing too few goods and services. You want actually a better balance. So the reason you would want to raise interest rates in the US, why the Federal Reserve wants to do that is if they believe the data points in the economy, whether it's hiring or GDP or consumption growth or even supplier growth, production growth, which is the Empire Manufacturing Surveys, PMI, if those are all concurrently firing on all 4 or 5 cylinders, then it's basically giving a strong reading to the Federal Reserve that we need to raise rates, otherwise inflation will set in and the value of the dollar will drop, although the US economy continues to rise in terms of real GDP. So it's very important that the economies and that the Federal Reserve and that the central banks, whether it's Europe or the US, they're keeping a tight control on the amount of money supply in the system. Okay, so that's the macroeconomic commentary behind the importance of interest rate decisions for those of you that are kind of new to this. But effectively, what you are looking to do is, if the forecasted number today, right, and this you can basically see in the consensus versus what the previous number was. Here's a consensus, and then the actual will show up on your calendar the moment it's printed, right? You want to basically see a beat. So if the interest rate expectation for today is 0.25% or 0.5%, and it comes out at 0.75%, that means interest rates have been raised higher than expected, and that's going to make the dollar shoot up versus a basket of currencies, right? Whether it's against the euro, whether it's against the Swiss franc or the Canadian dollar, what have you, it will shoot up. Equally, if the interest rate print is lower than expected, it'll make the underlying currency drop sharply for the reasons I've explained. Okay, and that's how you would play the interest rate decision. GDP releases are, again, somehow tied to interest rate decisions as well. I'll explain the link. But basically, GDP is the sum total of consumption in an economy by its consumers, by its inhabitants, investment by both um, private large corporations and small and medium enterprises. Okay, so investment, then government expenditure. The more the government spends, whether it's taxpayers' money or printed money that they've received as a loan from the Federal Reserve, and then of course the net of the company of the economy's trade balance, which is the exports minus the imports. The more economy exports, the better it is for the GDP. The more it imports, the worse it is for the GDP, right? So effectively, GDP is the grand total of those 5 variables: consumption, private investment, government expenditure, and net exports. And what you're looking for basically in the GDP is a percentage growth figure month on month or quarter on quarter. That's typically how it's measured, right? So for example, you see here gross domestic product month on month, MOM. This is for Canada. Again, this is just a fictitious date, right? See gross domestic product. The previous was 0.2% down, minus 0.2% down. And the consensus, which doesn't show here, but it will show on your calendar, let's say it was expecting 2% growth this month versus last month. And it comes out at 5% growth. Again, this is good for the underlying currency, in this case, the Canadian dollar. And if the figure is worse than expected, it'll move in the other direction. All right? So the GDP is a very important barometer of economic health and the overall economic condition in an economy. But it's somewhat lagging. It's very important that you realize that it's somewhat lagging because the inputs inside GDP, as I mentioned, there are 5 of them, right? There's consumption, there's investment, there's government expenditure, and there's net exports. And those individual variables often are reported before the GDP actually comes out on any given month. So investors and traders, retail and institutional, will look at those data points. For example, let's look at consumption, right, which is a key variable in the GDP equation. Consumption, people will look at consumer confidence surveys, right, even before GDP is printed. So one thing to note is the GDP, generally speaking, is a slightly lagging indicator. And unless it's a big beat or a big miss, it probably won't move the markets too much. But nevertheless, it's considered a high impact item when the US prints it, or when the certain Eurozone economies, or when China or Japan or Australia print it. It is definitely tradable. And that is how you would trade it. CPI, all right, this is consumer price inflation. This is the bit that the Federal Reserve is watching like a hawk all the time. They don't want too much inflation in the economy. Certain levels of inflation are important, okay? And deflation is very bad. So you don't want too much inflation. 2, 3, 4% inflation a year is too much. But a certain healthy amount of inflation is important. And this is what this barometer measures. CPI is a consumer price inflation. This means how much prices in an economy are going up, either on an annual basis or monthly basis. This is important for 2 reasons. If CPI is moving up, that means, generally speaking, producers, the manufacturers of services, products and services, are able to pass through price increases to the economy. That's a good thing because that means the demand is there. People are willing to pay a higher price for the products, right? But more importantly, CPI is a direct indicator of interest rate decisions. If the consumer price inflation is coming in ahead of expectations, so people are expecting 2% CPI in a month, and it comes out at 3%, right? All this tells you is that it's likely that the next interest rate decision will be in favor of a rate hike, which means it's good for the underlying currency. So to simplify, if today the UK CPI came in not at 1% but at 3%, the British pound would have shot up, okay? Because that would effectively make investors second guess or preempt the markets in saying that, okay, it looks like inflation levels in the UK are running ahead of expectations, so the interest rates are probably going to be notched upward rather than downward. And this applies the other way as well. If CPI is below expectations, it's bad for the currency. Then you have jobs numbers. these are now so over-researched and almost overhyped that everybody has a view on non-farm payroll data in the U.S. NFP, high school students, amateur account managers at brokerages, right to hotshot investment banking, head of proprietary trading desks or whatever. Everyone has a view. Everyone researches it, and that's why the number is so wrong as well sometimes, because it's so subject to herd mentality. I think it was 2 months ago, people were expecting a non-farm payroll number out of the U.S. of 250 or 260,000. It came out 130,000, right? It just goes to show you how wrong so many people can be about the markets. Most important thing, however, to note is that jobs numbers do move the markets, especially the U.S. jobs numbers, and of course, jobs numbers of major European economies. But it's the non-farm payroll report, NFP, which is released, I think, on the 7th or the first week Friday of every month, which shows the amount of jobs that are created in the U.S. economy in the non-farm sectors. So there are about, I think, 63 industries across the U.S., excluding the farm productivity and the farm sector. The non-farm payroll tells you how many jobs were created, right? And generally speaking, the U.S. economy is running at a rate of about 200,000 jobs a month, right, in that range, right? Now, the thing is, that job number becomes very tradable when there's a big beat or a miss. If there's a big beat, let's say it's 300,000 versus an expectation of 250,000, that's awesome for the dollar. The dollar will rise, and vice versa would fall if it's a big miss. All right? You will also get a secondary jobs report. This is known as initial claims data. This is the reverse. This shows how many people that are employed or seeking employment were actually unable to find it, and they were therefore applying for job seekers claims. Not really welfare, but basically they were applying for unemployed support in the economy. And that kind of shows a bit more the unemployment situation. But the non-farm payrolls number is the one that causes the most explosive trends in the market that you can trade. And remember, now I'm just going over the theory. We're going to go over exactly how to trade it when these figures are released after this. Parliament votes, are becoming increasingly important in the last 2 or 3 years. Obviously because of the potential Grexit risk, the risk of Greece leaving. So a lot of Parliament votes there and decisions there over the last 2 or 3 years have impacted the euro. And now again, we are waiting at the cusp of another potential decision that would potentially result in the Greek government at some point being re-elected, depending on how these negotiations pan out. But it's not only ring-fenced to Mediterranean Europe, it's also in the UK. The UK always holds these referendums increasingly now with a frequency to potentially leave the euro and the EU, right? So these parliament votes, these are part of these known unknowns I was discussing. When they happen, they can have catastrophic consequences on the underlying currency. If the UK left the EU, the GBP, the British pound, could fall sharply, right? Or it could rise sharply if they made a case that actually is going to increase the purchasing power of their currency and their economy in the long run. So these are very important to keep an eye on. They don't necessarily show up on economic calendars, so it's important to be kept abreast of this. And then last but not least is consumer confidence data. This is important because this gives you a clue on, are people actually hoarding cash? Because if people are earning from their employers but they're not spending, it almost is it's a cutoff of this virtuous or vicious cycle where employers can only pay higher salaries and accept wage inflation if the consumers then go on to take those salaries and purchase goods and services in the economy which the employers provide, right? So it's like this vicious cycle. And if people just make the buck stop with them, they collect all their monthly incomings and they save. It's good for the personal consumer, but it's not good for GDP, right? And then so it's bad for the currency. So these are the main things you want to trade. Now let's discuss, what exactly news trading looks like. For those of you that are trading with Bollinger Bands, you know what a Bollinger breakout is. All it basically is that the price, the first or the second candle, pierces above the upper Bollinger Band in a northern breakout or the southern Bollinger Band in a southern breakout. And it effectively creates a consecutive trend of similar colored and sized candles, right? I'm switching over now to the technical hat. So far I've been talking fundamentals, now I'm going to switch over to technicals. And effectively, this is normally this breakout where you get the Bollinger Bands constricting, looking at each other effectively, and then diverging in this hourglass shape, normally signifies that there is an event that has caused a repricing of the asset in the market. In this case, a revaluation of the euro versus the Canadian dollar. All right? And this is how news will typically manifest itself in the currency markets, actually, in the equity markets and the bond markets and the commodity markets as well. But now we're focusing on currencies. You effectively get a breakout. And this breakout effectively tells you that this warrants a price action strategy that needs to be deployed, right? You can't trade a mean reversion strategy. The price will just keep moving against you and your stops will be blown, right? So what we would suggest you to do is to trade in the direction of the trend after the news is released, but please wait for a confirmation of a second candle. That means on a 10-minute time frame chart or a 5-minute chart as well, so that you're giving some time for the information to be digested. And I'll tell you why that's important in a minute. Because a lot of traders like to get in and trade just ahead. They like to just, they want to say non-farm payrolls are going to be 300,000. And I would highly suggest you don't try and outguess or outanalyze investment banks who have a plethora of resources at their disposal, both research and transactional resources that can allow them to get a better edge on the market. So you as a retail trader, we would not advise you to try and predict news events. Wait until the news event is released. Wait 10 minutes, 10 to 15 minutes. Let the trend actually establish itself, right? Let maybe a R1 resistance or a support S1 resistance be broken. And then you would trade in the direction of the trend, all right? Not against it. If you're trading against it, then you're effectively saying that you don't believe in the numbers and that you believe the market is wrong, which is risky. The good news about these events is that there's a bit of herd mentality that takes over. If the non-farm payroll number is 20,000 jobs better than expected, even though it actually is meaningless because it's 1 month of the US economy's job creation or payroll, it still gets people into a euphoria and it could push the dollar up 200 pips against the euro, like we saw last time. So you want to play that herd. You want to be part of that herd, but you want to get in slightly earlier than others and then close your positions after, 15 or 30 pips. Now, here's the thing with news trading. Those are trading, duration trading, you're taking month-long positions, you're simulating a lot of fundamental news risk. You need wide stops, right? Because you need to be able to handle drawdown, and of course you're going to have a much larger variance in your non-crystallized positions before you actually take profit or you cut your losses. For those of you that scalp, you obviously trade with very tight stops, right? We teach scalping here on webinars as well, but for those of you that were in my previous webinar where I went over scalping, you'll remember I was telling you to keep your stops tight. The good news about trading news, pun intended, is that you can trade the news with tight stops. The reason behind this is once you've identified and confirmed that, okay, interest rates are going up better than expected, or higher than expected, or CPI data is better than expected, here it is, I see it on my economic calendar, you're basically confirming what the market already knows and is currently in the process of repricing. So you want to get on the boat, right? So it's unlikely that you're going to be wrong. If you're wrong, no problem, cut your losses early, which means trade news, event-driven news with tight stops, 10 to 15 pips. You won't need more, right? So if you're trading a breakout, you just want to set your stop loss possibly at the moving average. There's no need to expect that the price will go up, then come back down, and then shoot right back up. That happens, but it's very rare. All right. So 10 to 15 pips is a stop loss we would recommend you set. We recommend you set your take profit level relatively wide, right? Because news is explosive, so you can capture quite a few pips in a short amount of period. I would say 25 to 50 pips, but definitely so that your risk reward is 2 to 1. So if your stop loss is 15 pips, you want to be making 30 pips profit, right? Risk reward, remember, is just your potential pips captured divided by your absolute potential pips lost. And that should be always greater than 2 to 1, especially if you're trading news. In terms of when to enter, again, let me just ram that home. The news will take about, I would say, 10 to 15 minutes for the market to assimilate. When it's out, you may get some very big spikes up and down. That's a wrong time to get in. The moment you see that, you get excited, you get in because you may get the trade direction wrong. Let the market read the report. open up Bloomberg TV if necessary. They are analyzing it 24 hours a day. You can see what the analysts are saying there, how the market is reacting, and then take the position, right? So you don't have to feel you're going to miss out the trend in the first 5 minutes. Jumping in at the first 5 minutes can be risky. Okay. And last but not least, we would suggest you switch over to candlestick charts when you're trading news. I know some of you trade with just average bid and ask prices. Some of you trade with Heikinashi, but for the purposes of reading a breakout properly, we would suggest you switch to normal candlesticks, and definitely add Bollinger Bands to your analysis. They are a good radar, and they will tell you when the breakout is happening and when it's confirmed. Okay, now news trading dangers. I think this is very important. The strategy I give you is relatively simple. News trading dangers, these are important that you take these on board. There are a lot of robots and expert advisors. Be very careful with these because not a lot of them work during news. Even if the owners of the expert advisors have found a way to shut them off during news, there is a lot of news which is simply headline driven, right? Some news events are not planned, such as when Mario Draghi came out and said, we will do everything to save the euro in 2012, August or September. That wasn't planned on any economic calendar, but he came out and said it, and the euro shot up 300 pips that day, and then another 1,000 pips over the next 6 months. Literally 1,000 pips, all the way to 1.30. Okay, so, and these EAs, they get destroyed during these events, absolutely crushed. So be very careful when you're getting these algorithmic expert advisors to trade on your behalf. Please also note that news events that are numbers based, right? So GDP is numbers based, non-farm payrolls is numbers based. They may be followed by conferences that actually sway the price in the opposite direction. So sometimes you get a number, let's say non-farm payrolls were expected at 250,000 jobs. They came in at 260,000 jobs. Woohoo for the dollar. Dollar starts rising. But then there is some secondary report or the market looks into the job numbers and they see a big seasonal adjustment that wasn't apparent just in the numbers, right? And you actually read the seasonal adjustment and you actually say, well, actually it was owing to this seasonal factor or that seasonal factor. And boom, the underlying number is actually 220,000. The market reverses. This is why, and this happens sometimes, this is why you need to set your stop losses tight because you don't want to be caught in that reversal. Okay, this is a very important point, what I'm going to say next, and this comes from personal experience as well. When you're trading majors, like Euro US dollar, British pound US dollar, which is the cable, be careful, or US dollar Japanese yen for that matter. Be very careful of conflicting data sets. This can reduce and destroy your trades, even if you predicted the trade direction correctly. For example, if I am awaiting today US interest rate announcement in about 6 hours time, and I'm expecting interest rates will go up, okay? And let's say I don't believe this, but I'm saying just for an example's sake or hypothetically, today the US surprises the market and raises rates. In this case, immediately I want to jump on the board and I will go long the US dollar. But against which currency? That's the key thing, right? Against which currency am I going to go long? If I go long against the euro, most likely at 6 or 7 p.m. GMT, which is when the FOMC decides to raise rates, if they do, the Europe is already gone to bed, right? Mario Draghi is unlikely going to be standing there by the TV saying, okay, I got to get my word in. Where's the press? No, it's probably safe. You can trade this announcement versus the US versus the euro. So the euro US dollar is the pair to trade. But what if there is a CPI number, consumer price inflation number, coming out of the US at 2 p.m. when Europe is still open? The risk here is that even if you correctly predicted the US news right, what if countervailing news flow came in out of Europe 20 minutes into your trade? Right? So the dollar was rising. Suddenly the euro started rising as well. And then you get this tug of war, and that volatility could trigger your stop. What you want to do is you want to isolate news events. What I mean by isolate is basically make sure the dependent variable or the other currency where you have, let's say you have euro Swiss franc, right? Or let's say you have US dollar Swiss franc. The Swiss franc, the Swiss markets close at about 4 a.m. GMT, right? After that, no one is trading. There's no news that's going to be coming out of the Swiss National Bank or the Swiss economy after that. right? All the corporations in the Swiss are also in Switzerland are shut as well. It's safer for me to trade the U.S. news with Switzerland completely shut. The market is shut. So I actually trade U.S. news events versus the U.S. dollar or Swiss franc, of course, assuming the spread that my broker offers me is competitive. During news, sometimes the spread becomes large, it becomes 5 to 10 pips on some of these pairs. So you're forced to trade the majors like the euro US dollar, but you're also thereby accepting countervailing news flow risk, which I just mentioned. So if you have two potential news flows that can cause the pair to enter a tug of war, don't trade that particular cross. Trade a safer cross. Trade the euro versus the Swiss franc, right? Or the euro versus the Japanese yen when Japan has been shut for many hours already and is asleep. That's the way we would ask you to trade news. Okay. And last but not least are what we call head fakes. This will this is something that you will probably learn with experience as well for those of you that are new. Sometimes numbers are too good to be true or too bad to be true. Something must not be right. If non-farm payrolls was expected at 250,000, it comes out at 60,000. Could be a misprint, could be a data discrepancy, could be a massive seasonal adjustment. Be very careful to jump on board on those trades. Normally there are adjustments in play that cause a big deviation in the actual result versus the forecasted one. So the price may shoot in one direction, indicating a firm trend, but then recover very quickly and shoot in the opposite direction as well. All right, so be mindful of these dangers overall. A quick point on the accounts available to you here. So Tickmill offers ECN accounts with very low spreads, next to none. The commissions per lot are just 0.0020% notional. Minimum deposit is 300. Currency of your choice. The maximum leverage is 500 to 1. Minimum trade lots are 0.01. And the average execution speed is 0.3 seconds. Okay. And that's it. If you have any questions, please type via text to your left, and I'll be happy to address them now. Great question from Rumen Petrov. Rumen, that's a good point. Claimant count, claimant court numbers are actually not that important in the UK. The overarching theme today was actually the fact that there was no dissenters or no doves in the Monetary Policy Committee. It was a unanimous decision, 9-0, with regards to the next rate strategy, interest rate strategy. So for the investors that thought that there was some chance that the UK may not be reaching some sort of consensus, that the Monetary Policy Committee was not in consensus about how to take UK interest rate rises going forward, today their concerns were allayed, which means 9-0 is pretty decisive. They are pretty much in concert. They're pretty much in quorum with regards to how to go about raising rates in the UK going forward. So it was more focused on the vote as opposed to the claimant count. Any other questions, anybody? And while I'm waiting for questions, I think one point I would like to make clear. Technical traders are good. You know, I can trade technical as well, but nothing beats a trader that understands his or her fundamentals, everything I've gone over today, and can tie those in with the technicals, right? You're a different league of a trader if you actually learn a little bit about the macroeconomics and the fundamentals. So it's very important. And again, equally, those that are trading that are blind to the technicals and are purely trading fundamentals, you're missing a lot of opportunities because you can trade during the day on technical based moves as well. So you know, for those of you that are kind of limiting themselves, saying I'm only going to be a scalper, technical, or I'm only going to be a fundamental trader, actually the best is to marry the both together. Any other questions, anybody? A great question from Michael then. Michael is asking, will a big institution sway the news to move in an opposite direction even though fundamental and technical is supposed to follow trend? Okay, firstly, let me define what I think what Michael is referring to with a big institution can be quite a few players. It can be a large investment bank like JP Morgan or Goldman Sachs. It can be a large bond fund like PIMCO, which have very large impacts on currencies, and they, you know, typically tend to shore up on certain currency reserves. They can impact the market when they buy. Or it could also be large hedge funds. And a big institution can also be, to some degree, the World Bank. It could be the European Central Bank. It could also be a supranational institution like those, or it could be a country. So in answer to your question, Michael, the ones that can sway the market and that do play games with the market in certain instances, and it's again, it's not broad-based, it's not every investment bank, every hedge fund, but sometimes you will get this, they will hunt the stops in order to give the market the feeling that hey, actually the data is not that good, you should actually go short. And it's been done. If you are a market mover, you can move the market in the opposite direction. Because every time you buy and sell currency, you're impacting the market. These big institutions, they can plug in large program trades around from hero to give the impression to the market that it's moving one direction, but it then moves the other way. Normally, no single institution is big enough in order to make this happen, believe it or not. So what institutions do instead is they pre-position. Going into non-farm payroll, unfortunately, I have to say this, certain players in the game, in the FX game, certain players in trading in the various asset classes are privy to information that you retail traders are not. You saw this with non-farm payrolls, I believe it was last month or the month before. It was very sad to see, but it happened nonetheless. 20 minutes before non-farm payroll was released, you saw a very big spike up or drop in the dollar. It was a euro US dollar that spiked up and made no sense. Certainly was probably investigated by the CFTC and the SEC later, but the point is that someone received information before and they bought a big position ahead. And by the way, the price ended up rising after non-farm payroll. So in answer to your question, yes, big institutions will sway the market. They will hunt stops once in a while, and that's part of the game, unfortunately. But I think it's important that I address here, and it's not just because I'm doing this webinar for Tickmill, but you know, I've been a currency trader well before I was doing webinars. Brokers, FX brokers, for example, like Tickmill, they cannot move the market, even if they tried, right? They cannot. They're just not. They don't have big enough balance sheets. There's not one currency broker out there that can impact the market during NFP. Even if they load shedded their entire balance sheet on buying the euro, just making you believe that the euro is going to go up, it won't last, right? It's 5 trillion in liquidity. No broker, no FX broker even comes close to. Now that's the transactional reason. The moral reason is most brokers, they're agnostic, right? They have access to the market. They have access to liquidity providers. So they have no reason to hunt your stops. I always get very, although I was a novice trader myself a few years ago, the one thing I will give myself credit for is I never blamed the broker for my losses. I never blamed the broker for, oh, it's hunting my stops. The broker is not going to hunt your stops. Never. No, you're too small. Even if you have $500,000 in your account, you're too small. So, but in answer to your question, yes, certain institutional players will play games. They will definitely do that. It's the market, by the way, is purely psychology. So they will. Any other questions? Rumen, perfect. Yes. You nailed it spot on. So Rumen is asking, always wait for a Bollinger breakout. Correct. Choose a non-conflicting pair. Correct. You trade on M15. On MT4, there are no M10. Yeah, that's absolutely fine. There are no M10 on MT4. I don't use MT4, by the way, for my FX trading. I personally don't find it necessary, but it is the weapon of choice, so M15 is fine. And I do trade the US dollar, Swiss franc in NY session or the US dollar, Japanese yen, because both those markets are generally closed. I see a question from Mike Frisbee. Can you just roll a few slides back, please, where there were instructions, 4 bullets? Yes, one moment, please. Was it this one, Mike? These 4 bullets? Okay, Alexandra, good question. What to do when the data is mixed, one good, second bad? Okay, Alexandra, this is a fantastic question. You should never find yourself in this position if you've pre-planned the news day. For example, let's say you see non-farm payrolls is coming out on a Friday, right? The 7th of every month, roughly. At the same time, you see that Mario Draghi, again, he speaks so much, but he wants to say something, and he's also speaking half an hour after non-farm payrolls is coming. And you see both the events on your economic calendar. What do? You literally don't trade that day. Because anything he says will not only impact the euro, it will impact gold, silver, oil, it will impact Swiss franc, because you're basically getting risk on, risk off trades. You're getting carry trades. All types of investing strategies get activated when Mario Draghi talks. So in answer to your question, if you're getting conflicting data points, you already can see this on your economic calendar. Don't trade that event. Okay, Mike, a question from you. You're saying how news actually works. Are they electronically published the same second, or is it kind of speech mostly? Okay, great question. So normally, a lot of these events that I highlighted, the 6 events, they are data-driven. They are numbers-based events that you can trade just straight from the numbers. In some instances, there is a statement that follows, a qualitative statement released by the news, not the news agency, by the data agency that's releasing the information. For example, the Bureau of Labor Statistics in the USA, the BLA, releases the non-farm payroll number. They compile it, they release it, and they release a statement that investors read. In some rare instances, the number that you see is not jiving or in concert with the actual statement. What the statement is saying is different than the number in the qualitative commentary. And that can cause some volatility in numbers, but that's only 10% of the cases or so. Now, both are released at the same time, normally, and this is why we say give it 10 minutes for the news to assimilate, for the market to decide where they want to go. This is why I'm telling you, the retail trader, because you don't have access to this report. You can get access. I think there are some paid news agencies, but why bother? It's not like those 10 minutes make a big difference anyway. But effectively, they are normally released by the news wires. In answer to your question, they are released by the news wires, like Reuters, and they hit, I think, millions of nodes at the same time. All types of daily FX blogs, all types of news channels, etc., Twitter, and effectively that's the kind of dissemination of information. But they are definitely electronically published. Any other questions? Mike, and sorry, I missed the second part of your question. Indeed, there is a speech as well sometimes, right? So for example, Tonight there's going to be an FOMC announcement. Whether USA raises rates or not or keeps them in line, I don't know. But whatever happens, then the chairwoman or the chairperson of the Federal Reserve, in this case Janet Yellen, will actually give a short speech, and there'll be a Q&A session. And you can get access to this feed on many sites. Just Google it. Google live Federal Reserve commentary, Yellen or whatever. Bloomberg covers it as well. Bloomberg TV, which is free on the Bloomberg website, and you normally get a camera in the room so you can see what she's saying as well. And the same holds true for European Central Bank interest rate announcements. Now, in the case of the European Central Bank, the actual numbers released at X, and the interview with Mario Draghi is 45 minutes after X, and that's a speech that continues for about an hour. So you need to take that into account as well. Ruben, in answer to your question, will I trade the news right after 2 p.m.? I'd wait 10 to 15 minutes. Will I wait for this conference? Probably not, but that's because I've been doing this for a while, and it's very rare for the USA to say something different. It's rare for Yellen to say something that doesn't tally with the numbers. It happens in Europe, not so much in the US. Suraj, your question on the Fed funds rate this afternoon should be safe on the US, Japanese, and Euro, USD, and GBP. Yes, from those three, Suraj, I would say the safest is the US dollar, Japanese yen, because the Japan market will be closed by then. Any other questions? Michael, good question. Michael's asking, how often will the BOJ, the Bank of Japan, which is the Japanese equivalent of the Federal Reserve, intervene in news related like USD JPY or GBP JPY? They tend to coordinate, so you will rarely get them releasing interest rate decisions on the same day. I can't say it's never, you rarely get that. And if you do, you see it on your economic calendar. And also remember, there's a timing difference, Michael. So the Bank of Japan normally releases news at, I think, around 6 p.m. New York time, roughly speaking, right? So about 10 or 11 p.m. GMT. And that time the U.S. markets are shut, or they're in the final few stages. So it won't impact. It's not like you get the Bank of Japan making statements while the U.S. is releasing interest rate data. That's rare. Now today, obviously, indeed, it is happening at 6 to 7 p.m. GMT. It's a late release, the Fed funds rate, and in theory, the Japanese market will be open. But I don't see anything planned by Japan today, unless I've missed it. But if you do see that the BOJ is planning a release at the same time, just trade the US dollar Swiss franc. In my personal opinion and experience, that's been the safest pair to trade US announcements with. Because the Switzerland, they rarely release any news. Obviously, when they release news, it destroys the market, like we saw with the Swiss National Bank, which took down multiple currency brokerages in a week. But for the most part of it, they're quiet. Any other questions? All right, Ruben, I see what you're saying. You're saying you could never trade the news, right? It would be great if we can at least see a pre-recorded trade to see exactly how this is traded and hear all the reasoning before the trade, at the time of the trade, and after the trade. Sure, Ruben. It's not something we're going to do on, I think, under this format, but let me discuss this with the Tickmill people, and maybe there is something that I can put together, maybe like a recording, and it shows me trading the news, setting my take profit stop loss levels, going through the analysis, me telling you what I believe the numbers are, me trading in the direction of the news, and hopefully me not having my stop losses triggered, which would be quite funny, but having my take profit levels triggered, and then maybe I can post that. I would need to discuss this with the management team. Sure. Any other questions, anybody? Suraj, very good question. If a news event occurs, Suraj is asking, and the market establishes a direction, would it continue moving in that direction until another event? Suraj, it's a very good question. It would up until a certain point. Remember, the market only moves incrementally in one direction when new buyers come in, right? They believe that the asset is undervalued. I want to buy more. I believe the asset is undervalued more. I want to buy more. This process continues until exhaustion starts to set in. Have you ever seen a shooting star candlestick? For those of you that know candlestick theory out of Japan, when you start to see candles that have larger wicks relative to the candle body, so candle body to wick ratio starts to decrease progressively until eventually you start to see dojis, which are reversal patterns, or shooting stars. That's telling you that no, now the market has risen enough and people are looking to take profits, right? And that's not a time to enter the trade. So it's not like the cosmos, like space, that if you push an object in space, it will continue moving forward absent any friction until another object changes its trajectory. It's not how the markets work. There is a finite limit to how much the price will rise and fall based on the magnitude of the event, if that makes sense. Okay, so, but what I will say in answer to your question is the market can remain ranging within a range, within a very tight range, for days if there's no news. That's the beauty. So the market can go into this stasis mode, which basically just moves in a range. It could be a wide range or a short range until new information enters the market, which is normally through news. And that would then trigger a trend, if that makes sense. So the default mode of the market is not to move in one direction until perturbed or disturbed, but the default mode is actually to range and then move in a new direction for some time if driven by news. All right. Any other questions? And by the way, there's one strategy that I haven't discussed today that pertains to the news as well. This is the plain vanilla way of trading news, right? You're trading the direction. The other way of trading the news is just wait. Just wait 6-7 hours after the news, start to wait for these exhaustion patterns that I went over, and then take a trade in the opposite direction. You may need to bring out your Fibonacci retracement grid to see until where price could retrace until or correct until. That's a more scalping strategy, by the way, maybe 15, 20 pips or whatever. But for those of you that are intimidated to a certain degree, and I don't blame you, I was as well, but trading news can be quite daunting. You can just wait for the news to play out, wait till the price has exhausted itself, and then trade in the opposite direction. But you certainly can't do that during the hour the news is released, right? That's just, it's suicide. You need to wait a few hours for the liquidity to play out. Any other questions? Seeing some more questions coming through. Yeah, Suraj, it's a good question. So first of all, take a look. Suraj is asking, by the way, everybody, he's asking if the GBP has any chance of give back. It has risen strongly in the last few days, especially against the Japanese yen. Any thoughts on a drop? Again, Suraj, I don't personally follow the British pound. I don't trade the British pound USD. My focus is more on US dollar news and playing it against other currencies and the euro. But if you go back to 2007, 2008, the British pound versus a basket of currencies was at all-time highs or near all-time highs, right? British pound was at 1 to 2 versus the dollar, right? And over the years, it's taken quite a few hits, and it came down all the way to 1.45, I think, at some point this year. Structurally speaking, some of that is driven by oil, obviously, because of the UK's corporate exposure to oil. But generally speaking, if you look at the health of the the UK economy, which is very good, my personal belief is that, and again, this is no investment advice. My personal belief is that the British pound, structurally, relative to where it was in the last few years, is undervalued. So, in the grander scheme of things, unless you see exhaustion patterns setting in, if you look at your hourly candles or your daily candles and you start to see dojis or shooting stars or inverted hammers or whatever, and you're starting to see that the British pound, Japanese yen is overheating, I would not bet against the trend just yet, especially since we saw this 9-0 today. You just never know. There could be another leg up. So again, this is not investment advice, but this is just using common logic in terms of looking at where the UK economy is. They've just had a successful election go through, and the only event risk that could bring the British pound down possibly is a surprise announcement that the UK would leave the EU and what impact that would have on the British pound. But excluding that kind of known unknown from your analysis, I don't personally see any reason, unless you're seeing technical reasons, to necessarily start shorting the British pound versus the Japanese yen. Looking at the yen, which could rise and drop the GBP JPY, that's a different story. Then you need to take a view on the Japanese fundamentals, right? And that's the key thing with predicting these larger time frame calls. Like, do you go long the British pound, Japanese yen, or short right now? The answer only comes when you can analyze both macroeconomic forces on both pairs, not just one. Yeah, Alexandra, thank you for that comment. So I'm seeing that a lot of you want these live trading things. I won't be trading live in front of you. It's just a time thing. My time is quite limited during the week, but I will, as I said, I'll speak to Tickmill, and if it helps you, I may have the time to trade a news live and record it and then send it to you. Ruben, your question on if you would trade the GBP news during a London session, what pair that is non-conflicting would you recommend? JPY is one, because JPY is closed during the London session most of the time, right? You could trade it against the AUD, because again, Australasia, generally Australia is closed as well at that point. So the AUD and the JPY would be the safer one. One point to note though, AUD is a commodity currency. So it will react to news related to oil, which can come out during the day. Whereas Japanese news won't come out during the day when Japan is closed. But I see your point that GBP JPY is very volatile. Historically, I totally agree with you. Its volatility signature is high. For what it's worth, I'll reiterate, I just don't trade the British pound. I find trading the US dollar Swiss franc much more predictable, easier. I don't trade the US dollar Canadian for the same reason. And the British pound JPY is a risky pair. It has inherently different volatility characteristics. So in answer to your question, yeah, I kind of stick to Euro US dollar and US dollar Swiss franc. Those are my go-to pairs. And even the Australian dollar USD, I find more predictable. The British pound, for me, cable, which is British pound USD, has been the most difficult pair to predict and trade. Any other questions? I see a question from Istvan Gori about the text in the right side, bots and news. Yes, please go ahead. What is your question on that? Istvan, I say this because of personal experience. I have lost about exchange rate, let's assume 1.5, about $9,000 1.5 years ago. I invested in a lot of expert advisors that were touted to be amazing, the best ones, top expert advisors. You try them. I invested, lost a lot of money in them, and then I ended up finding out they were actually not created by real traders. They was part of an affiliate marketing scheme. So if you look at the top kind of known expert advisors, unfortunately, and this is my experience with real money over a 1 year period, I ended up poorer than richer after using them. So I'm saying that a lot of them are scams. Not all, maybe there are a few that I haven't come across, but these expert advisors may make you money in a month or two. And I got very excited as well when some of these were making money for me, but eventually they fail miserably because they cannot predict black swan events. They cannot predict uh, event-driven news. They can be shut off manually for predictable news, but not unpredictable news. And so there is, in my experience, just trading by myself is more profitable over the longer run. Your question, Adom Kunikas, can I get the recording? Yeah, I believe this is recorded. You can get in touch with your account manager at Tickmill. They will guide you. Yeah, Ruben, great question. So you're saying there are a lot of companies that use these in-house automated trading systems. You were even interviewed in New York. Totally. Don't get me wrong. So just to be clear, I'm talking about expert advisors available for the retail traders, right? The gimps, like the people like us, you and me, that have normal tools at their disposal. Like you, I have an investment banking background, and I work very closely with algorithmic structures that created algorithms, microalgorithms, artificially intelligent algorithms, genetic algorithms that exploit, micro pipette differentials in the market very quickly, quicker than any human, and they can make a lot of money for the investment bank or the hedge fund in play. That is at a different league that we're talking about. Those things are not made public. They would never be made public, right? Those are perpetual money machines to some degree. I'm talking about your usual tin pot expert advisor that's found on a website, right? You're 100% right that, especially in New York and in London, uh, where there's a lot of money behind this, there's a lot of technologies that are at play that are arbitraging these market opportunities robotically. We are not made privy to them. I myself run a technology company where we have developed some of these technologies. Again, these are not commercialized, right? We're using them internally. So we're not selling them for 29 a month, just to be clear. So they exist. You're 100% right. There's no doubt about it. They're very smart. They're getting smarter as well, but not the garbage one sees on websites. At least not in my experience. If you find one on a website, definitely, if it works for you, use it. And Ruben, if I may say, you should probably reapply for that position. It would be a good one. Exactly, Ruben. I mean, I think you hit the nail on the head there. You know, if they're so good, they would be using them, and you would never need to sell them, right? Istvan, yes. So you're asking if I already spoke about news trading? Yes, I spoke about news trading earlier on. I started about one hour ago. But I think this webinar is recorded, so you can get access to it. And if not, I'll probably be giving this webinar again in a few weeks from now. So it's no problem at all. Any remaining questions, anybody? Okay, I see a question from Jan Lennartz. If trading both news and technical as a beginner and not making any mistake, what would you think can be earned if starts amount is 10,000 euro? Okay, so firstly, as a beginner, Jan, 10,000 euros, you don't need to deposit that amount of money. It makes no sense. You need to focus on rectifying your trade process. Your trade process is not about winning, but it's about how you reach your long and short decisions to go long or short. That itself is a factor of your technical knowledge and your fundamental knowledge. And then the other 50% of this equation, and I stress that it is so important, is your money management, especially your profit factor. So I'm going to give you a slightly long-winded response to this. If you have 10,000 euros, that's a good amount. That's a realistic amount because you can't make a lot of money in FX with $100, $200 accounts, right? With 10,000 euros, you can opt for safe levels of leverage, which is, let's say, 5 to 1 or 10 to 1, not these crazy 500 to 1 accounts. Let's say 5-1 to 10 to 1. And with this, as long as your trade process is rectified, as long as you have used it on virtual money or very small amounts of real money, and you've been able to consistently generate profit for a period of 3 months, not 2 or 3 weeks, but 3 months, inside and outside of news flow, then you deserve to go to your 10,000 euro account and grow that. If you are using a combination of news and technical, you can generate, and I'll give you some statistics, the best traders in FX are making about 1% return on invested capital per day on their account. 1% a day is considered phenomenal because remember, you're not doing this for 3 months. You want to do this as a career, right? So about 30% a month prior to any fees, what have you. So on a 10,000 euro account, if you are really good, you can make 3,000 without exceeding, crazy risk levels. So within good risk management, 3,000 euros is doable. Good traders are making 15% a month. So roughly in the range of 0.5%, that kind of per day. And that can be done, right? 15% a month, which over a year is awesome, right? I mean, the equity markets give you 10 to 15% a year. You can make that in a month in FX. So the FX is a high return, but also equally a high risk asset class. So that kind of, if you do your calculation, once you are ready, if you're a beginner, then you're not ready in my books to play with a 10,000 euro account, but it's to you. But once you're ready, you can grow that 10,000 euro account at a compounding rate, whatever rate it is. Let's say you end up at 10% return per month, right? And you compound that over a 5-year period. That's roughly what you can make. Okay, I see a question from Suraj Ramsawak. What percentage of my equity should I risk on a news event trade? Tight stops equals higher than average leverage. Suraj, with regards to leverage, I don't personally cross more than 10 to 1. The most I've ever been is 40 to 1. I'm personally not a fan of these very large leveraged accounts. But I agree with you that on a news trade, you could maybe slightly increase the leverage more than usual if you're using tight stops. With regards to what percentage of your equity, you can use the Kelly risk management criterion, which takes into account your historical trading patterns, your win rate, and your profit factor. Never more than, I mean, again, it depends on the size of your account. If you have a $100 account, then yes, you can, wager 5 to 10% of your account. per trade. But if you are sitting on a account which is $5,000 or something substantial, I personally would not trade more than 2% of my account. You know, some say 5%, but I find that quite excessive. So kind of 1 to 2%. Closer to 1%. That's what I personally trade with. Maximum 2% of your equity. Any other questions? Yes, Mike, you're absolutely right. So it all looks great on paper, doesn't it? With 10K and 15% per month, you would make more than 3 million in 5 years. It's not realistic. Yeah, you're 100% right. And the reason behind that is you're gonna have bad weeks. You're gonna maybe even have a bad month. And when you are losing consecutively, and every trader goes through it, what differentiates the long-term traders that become millionaires, which is only 10% or 5% of the market, versus the normal Joe Schmo, is how they handle those losses. Most people get back into the market immediately, 1 hour later or immediately, and they start buying more loss, they start martingale, they start revenge trading. That's the normal human thing to do, and that results in long-term ruin and failure. If you strip out the emotion, and this is why the whole industry of expert advisors and robotic traders and algorithms was created, that is where actually you could turn 10K at a 15% per month into 3 million in 5 years mathematically, because there is no emotion in the equation, right? Has that been done? Yes. Has it been done on the fringe, or is this something that's done every day? It's definitely on the fringe. It's very tough, right? So brutally, bluntly put, I would say 15% a month is actually pretty awesome. More realistically, it's probably going to be 5% a month, which is actually 5 to maybe 10% if you have a great month, which is actually awesome on an annual basis, right? It's 100 times what cash is returning you in the bank account. It's 10 times what the equity markets are returning you, right? And 30 times what the bond markets are returning. So it's, you have to compare it to other asset classes, right? In FX, you're going to be beating other asset classes with a medium amount of knowledge. You can make money. But for people that want to become millionaires with $10,000 accounts, you have to be very unemotional to be able to do that, right? What is easier is, you know, you have a you're lucky and you have a lot of money and you start $100,000 account, you can trade reasonably, then you can make $5,000 a month, right? 5% a month is not a problem. That's very doable, and that's a very decent salary, even 10,000 a good month. So it's kind of a chicken and egg issue we have here, right? It's like, well, how does this actually work? Why is this exciting? Because I need a lot of money in FX to make a lot of money with low risk. That's true, right? If you had $1 million account, um, it's easier for you to make $10,000 than making $10,000 with a $10,000 account. Both are mathematically possible. You just have to crank up the leverage from here to the moon on the ladder. And yes, Suraj, it's a great point. The law of large numbers, the emotional impact of large numbers. It's very easy to grow a $500 account to 1,000. It's more difficult to grow 50,000 to 100,000. Those larger trades, the larger lot sizes, they play on you emotionally. Let me put it to you this way. Let's say you're in the money by 15 pips. Your stop loss is 15 pips below. Your take profit is 10 pips away. If you were going to win only $200 on that trade, you might wait, right? You might wait for the price to move up so that you capture the additional pips. However, if you are going to be making $15,000 on this trade, you're probably going to close the position now, right? And capture that 15,000 rather than wait to make 20. Because the flip side is if you're not using trailing stop losses, the price could reverse and you've lost it all. You've lost all the gains. So I totally agree with you. It's, having been there myself, I have managed, kind of $30,000-$40,000 of my own money. It was tough to grow that account. It was easier for me to grow my 5,000 pound account, which I did. Any other questions, anybody? All right, I see no questions. Last call for questions. No, I see more questions. Okay, great. All right, everybody. Well, thank you for your time today, and I look forward to seeing you all soon. All right, have a great trading day, and good luck with the interest rates today.